Good day. Welcome to the first of 4 lectures on Chapter 3 Cost Volume Profit Analysis. Our objectives in these lectures are listed below. We will be covering Objective 1 in this lecture, Objective 2 in the second lecture, and so on. Objective 4 we will not be looking at this year. Objective 4 will be covered in third year. Objective 1. Explain contribution margin and calculate contribution margin per unit, contribution margin ratio, and total contribution margin. Contribution margin is the amount by which unit selling price exceeds unit variable cost. Contribution margin per unit is useful to management because it represents the amount each unit sold contributes towards covering fixed costs. Unit contribution margin is equal to unit selling price minus unit variable cost. Let us consider an example. Hicks Manufacturing is a small company that manufactures and sells bird baths to specialty retailers. Hicks Manufacturing sells its Blue Jay model for 100 Rand each and incurs variable costs of 20 Rand per unit. Monthly fixed costs are 18,000 Rand. Calculate contribution margin per unit. Contribution margin per unit is equal to sales minus variable costs. So the selling price per unit 100 Rand minus the variable cost per unit of 20 Rand, the contribution margin per unit is equal to 80 Rand. We can also calculate a contribution margin ratio, which is equal to contribution margin per unit divided by selling price per unit. So going back to our previous example, the contribution margin ratio would be the contribution per unit of 80 Rand divided by the selling price per unit of 100 Rand. The contribution margin ratio would be 0.8. This means that 80 cents of every sales Rand goes towards meeting fixed costs, and once those are met, 80 cents of every sales Rand will go towards profit. Total contribution margin is equal to number of units sold times contribution margin per unit. Suppose in March Hicks sold 400 Blue Jay models. So total contribution margin is equal to 400 units times 80 Rand per unit equal to 32,000 Rand. Contribution margin format income statement. This is an income statement that separates variable costs from fixed costs. It is a useful tool for analyzing the effect of changes in sales price, variable costs, or fixed costs. Prepare a March income statement for Hicks in contribution format. Hicks sold 400 units in March, so the total sales will be 400 times 100 Rand less variable costs, 400 units times 20 Rand per unit. Total variable costs will be 8,000 Rand. Sales minus variable costs is equal to contribution margin. Contribution margin minus fixed costs is equal to operating income. So this is the standard format for a contribution margin income statement. Sales less variable costs equal to contribution margin minus fixed costs equal to operating income. Finding total contribution margin based on Rand sales. total sales times contribution margin ratio is equal to total contribution margin. If we are told that sales in May was 75,000 Rand in total, we can calculate what the total contribution margin would be in Rand terms by taking the sales of 75,000 Rand, multiplying it by our contribution margin ratio of 80% equal to 60,000 Rand. So this is what our contribution margin would be based on sales of 75,000 Rand. Finding units sold using contribution margin. If we are told that in April total contribution is 40,000 Rand, we know our per unit contribution is 80 Rand. Therefore, we must have sold 40,000 divided by 80 Rand. We must have sold 500 units. So total contribution margin divided by per unit contribution margin is equal to the number of units sold. Let's look at an example deciding between two orders. You are evaluating orders from two new customers, but you will only be able to accept one of the orders without increasing your fixed costs. So you want to avoid increasing your fixed costs, so you want to accept one order only. Management has directed you to choose the one that is most profitable for the company. So customer A wants to order 500 units and he will pay 200 Rand per unit, and these units have a contribution margin of 60 Rand per unit. Customer B will order 1,000 units and is willing to pay 140 Rand per unit, and these units have a contribution margin ratio of 40%. Now you need to determine which order you will accept and why. If we calculate the total contribution from each order, customer A will order 500 units, okay, and the unit contribution margin is 60 Rand per unit. Therefore, we will make a total contribution of 30,000 Rand from customer A. Customer B will order 1,000 units. He will pay 140 Rand per unit, and the contribution margin ratio is 40%. Therefore, 1,000 times 140 Rand is 140,000 Rand total sales times a contribution margin ratio of 40%. It would mean that the total contribution we would earn on those sales is 140,000 times 40% equal to 56,000 Rand. Therefore, we will accept customer B because customer B will give us a higher total contribution margin. That brings us to the end of Chapter 3, Lecture 1. Thank you.